Stocks in general are hitting new highs again as investors embrace riskier assets ahead of the Jackson Hole meeting later this week. Is the Fed papering over weak fundamentals, or is earnings growth strong enough to justify this ongoing rally? Joining me now is John Augustine. He's the Chief Investment Officer at Huntington Private Bank. John, let's talk earnings per share for the S&P 500. Where were we pre-pandemic? Where are we this year? Where are we going?
So earnings continue, in our estimate, to come higher, Kelly. Earnings estimates, as you know, are going to be 95% for this quarter, or earnings, I should say. What we're surprised at is so far forward earnings estimates are not coming down. That's a huge support for stocks in our view.
Not coming down is not the same as them going up.
No.
Yeah, so let's talk. I mean, what are the expectations now? When people are looking at these multiples, as Bob Pisani always talks about time and again, and thinking, okay, well, for example, is a 30 multiple justified? Is it possible that I could get decent earnings growth in 22 after the huge rebounds we've seen this year? What would you tell them?
Yes. So in other words, we have a 9% earnings growth expectation for the S&P 500 next year. The forward earnings multiple is 9. That's right on the edge, we would say, of overvaluation. We're at 2 times earnings growth rate. But Kelly, what we're looking at is that bond yield. We're still in an environment where stocks yield more than bonds.
The S&P 500 today, 4488, John. 4,500 would be the next round number. 5,000 we're starting to see in some analysts' price targets. Where are you? What do you think is feasible here?
Well, our equity team looks at 4,600 by year end. So they're using a 23 trailing multiple, $200 per share. So that's what we're looking for the end of this year. Still a little upside. And as mentioned, in a low interest rate environment, still attractive to us. So that's what we're looking at now. And again, Kelly, the surprise to us is just forward earnings estimates. We haven't seen them come down very much.
Yeah, and in terms of specific likes here, just so everybody's aware, you've got names like Cisco, J&J, Parker Hannifin, Caterpillar, Crown Castle, and Microsoft. So a lot of different industries represented. There's just a question about the Fed and stimulus. Do either move the needle for you? I mean, it's interesting how the market can basically go, we don't really have to worry about the Fed. They're going to figure it out. If that means delay the taper, they'll delay. If it means taper, they'll taper, and we'll all kind of deal with it, or maybe use any sell-offs to get more risk exposure. It's amazing how little consternation there really seems to be with the Fed these days.
Yeah, there is. And actually overnight, we would say what happened is People's Bank of China came in with support for their economy, as you've been reporting, is under some fire on the other side of it, the regulatory side of it. So the Fed this week, Thursday, Jackson Hole, virtual. We don't think they're going to do anything to try to upset markets. They may back off slightly of taper talk, given the resurgence in the virus. We just don't see them pulling back stimulus too soon. It's just not in the cards in our view from our economic team.